Yesterday, the euro and the British pound extended losses against the dollar, weighed down by data from the United States. U.S. consumer spending, inflation, and labor market conditions have eased lately, indicating a slowdown in economic growth. This means that the Federal Reserve will have to keep interest rates on hold and probably announce the end of its tightening cycle. After all, further rate hikes could only harm the economy. Besides, the euro came under pressure from Euro statistics. Germany's unemployment rate rose. Inflation in the euro area dropped to 2.4% in November from 2.9% in October, well below forecasts. Core inflation in the region fell to 3.6% from 4.2%, providing fuel for expectations of ECB interest rate cuts. Against this background, the market entered a bearish correction, which was long overdue after an impressive rally in November. Before we get into technical analysis, let's take a look at today's macroeconomic calendar. It includes a batch of manufacturing PMIs for Spain, Italy, France, Germany, and the euro area. If factor activity in the region shrinks further, the euro's bearish correction will continue. Traders may also take notice of ECB President Christine Lagarde's speech. Yesterday, she expressed the need to keep interest rates high to curb inflation. However, data showed that consumer inflation cooled more than expected, bolstering expectations that the European Central Bank would start cutting interest rates as early as next year. If Lagarde takes a soft stance on future rates today, the euro will come under stronger pressure. Speaking of the U.S. statistics, the Institute for Supply Management is set to release its manufacturing PMI. The index is forecast to rise but remain below the 50-point mark, indicating contraction in activity. The focus of market participants will be on speech by Fed Chair Jerome Powell. If he signals no rate hikes in December and their cuts in 2024, the euro will have a chance of gaining value with the greenback losing ground. At the same time, given that the ECB may take the same approach and the euro is deep in overbought territory, the currency may well edge lower. According to the 1-hour chart, if the price breaks through and consolidates above 1.0917, the euro will most likely head for 1.0947 and 1.0979. At the level of 1.0979, I recommend going short on a rebound to catch an intraday correction of 25-30 pips. Short positions at 1.0917 and 1.0947 can be considered only amid a false breakout. In this case, the euro is expected to dive to 1.0885. Its breakout will open the way to 1.0857 or even 1.0827. At the level of 1.0827, it would be a wise decision to go long on a rebound, counting on an intraday correction of 25-30 pips. Going long at 1.0885 and 1.0857 will be relevant in case of a false breakout. Meanwhile, the British pound is trading in a wide sideways range. A rise followed by a false breakout at 1.2664 amid downbeat data on UK manufacturing activity will create a sell signal, thus dragging the sterling down to 1.2609. If bulls regain control of the market, forming a false breakout at this level, a buy signal will be generated. Alternatively, if the price breaks above 1.2664 and tests it from the top down, the British currency will likely rise to 1.2722. However, much will depend on Powell's remarks. At this mark, traders are recommended to go short on a rebound to make money on a move of 35-40 pips. Short positions can also be considered at 1.2761 if sterling hits a new one-month high. In case of tough comments by the head of the US Central Bank, the price may fix below 1.2609 and then extend weakness to 1.2563 and 1.2526. At these marks, it will be possible to open long positions on a rebound, counting on an intraday correction of 30-35 pips. Good luck and have a nice weekend.